Okay, hello everyone, I'm James Hart and welcome to this Orbex Trader Education session where we're going to be talking about price action trading strategies. Now, price action trading is one of the most popular and effective technical approaches, and in this session I'm going to talk about exactly what price action trading is, as well as showing you a few different setups and walking you through some strategies that you can use. So whether you're new to Forex trading and looking to learn about this style of trading, or whether you've been in the market for a while and are just looking for a little refresher, you should find this webinar really useful. So as ever, if you have any questions during the session, just type them in the chat box and I'll stop periodically as we go along, and then we'll also have some time at the end for any questions. Okay, so let's jump straight in then and kick off with what price action trading is. So when we focus on price action, we're simply studying the historical, recent and current movement of price to gain an understanding of how the instrument behaves, seeking to identify patterns and sequences that tend to yield specific results with a view to then taking advantage of future instances of these patterns. Now, you might have heard the term price action bandied around quite a lot, and I know that for new traders, it can sometimes be a little confusing because different people tend to mean different things when they're talking about price action. But generally, you just need to remember that price action trading simply refers to the study of the charts without the use of technical indicators. Okay, so that's it. So whether we're talking about trend lines and channels, support and resistance, chart patterns, or just candlestick reading, this all comes under the banner of price action trading. So it really does just refer to analyzing and trading the charts without the use of any technical indicators. Okay, so what we're going to do then is simply walk through a few different setups and I'll explain what's going on, and we'll look at how you can use these different elements of price action, and this should hopefully give you an idea of the different ways that you can approach the market using price action strategies. Okay, so the first strategy we're going to look at then is a simple breakout strategy. Okay, and breakout trading is simply where we look to capture an expansion in price as it moves beyond either a defined high or a defined low point. So this is a really simple yet powerful way to trade, and because we're looking to capitalize on momentum in the market, you often find that winning breakout trades occur quite quickly. Okay, so in this example then, you can see that we have price making this explosive move higher. We've got a long succession of bullish candles showing that bullish momentum is building. However, in the highlighted block here, you can see that we have a classic range. Okay, so price has lost momentum and we've settled into a range oscillating between this high point and this low point. So at this point in time, we can see that the market has moved through a period of expansion. We've then settled into a period of consolidation. And so when we identify this happening, this type of movement in price, we can anticipate that at some point price is likely to continue to move in the direction that it made initially. Okay, so where we see price making this type of bullish move, a lot of momentum in the market, and then we stall and start to consolidate in this range, we can anticipate that price is likely to break out above the high of the range, and this gives us our opportunity to take a simple breakout trade. So again, this is a really simple way of using the natural ebb and flow of the market, the natural way in which the market tends to move through periods of expansion and consolidation to your advantage. So once you've highlighted this range, then we simply wait for price to break out above the range high, and this gives us our entry point. Now, the typical way in which you would trade this is to get a long position entered as price breaks above the high of the range, and then your stop will go below the low of the range, and then at a minimum you'd want to be targeting 2 times your risk. Okay, so if our stop is the width of the range, then we're simply looking to target a move in price which is equal to 2 times the distance of the range. Now, many traders will enter a breakout trade as soon as price breaches the boundaries of the range, and they'll typically do this before the candle has closed. So they'll identify the range high, and then as soon as price moves above the high of that range, they'll simply enter a buy trade. However, this is quite a risky strategy because entering the market in this manner exposes you to the risk of catching a false breakout where price breaks above the high of the range before quickly reversing back inside and then often trading back down to the other side of the range. So in this instance, where we're trading long, what we really want to see is a candle close above the range high. So we want to wait for what we call price action confirmation. So we're looking for price not only to move above the high of the range, but also to close above the high of the range. Because what this does is add more weight to our bias. Okay, it shows that buyers in this instance, because this is a bullish setup, were strong enough and had enough power to keep price above the high of the range throughout the duration of that session, or sufficient enough rather to close above the boundary of the range at the end of that session. And so when we see that happen, that increases our conviction in taking the long trade. So if we look at this area, then you can see that the candle which first closes above the range high is this candle here. So what we would simply do then is wait for price to break above the high of that candle where we'd enter our long trade, and then again have our stop below the low of the range, and then at a minimum we're looking to target 2 times the width of the range. So this is a very simple yet effective way of taking these breakout trades. And the basis of the trade here is that we're looking to trade with the trend. So we've identified a bullish move in price. We've then identified a period of consolidation, and we anticipate that price is going to continue in the direction that it first started. And so we're looking to take long trades only. Okay, so in this instance, we wouldn't be looking to take a short trade if price broke down below the low of that range, because that's not in the direction of the trend. Now again, if this was a bearish trade, for example, so if the market had sold off and we got a move lower, and then we'd formed a small range, a period of consolidation, we'd then be looking to sell price as it broke down below the low of the range. Okay, so you can trade this type of setup in either direction, but the important thing is to make sure that you're aligned with the trend. Waleed asks, does it work on any time frame? It does work on any time frame. Obviously, you have to remember that the lower the time frame, the more noise there is, and the shorter term the moves tend to be. But you can see here that this is a 30-minute chart. So this is a very short-term trade, but again, it works just as well on the H4 or the daily. The key thing, as I say, is making sure that you align with the trend. So you're looking to align yourself with that natural ebb and flow of the market, the period of expansion, the period of consolidation, and then a further period of expansion. So it's really just about capitalizing on the natural momentum that you find during these periods. Okay, another approach then that you can take is trading the retest after the breakout, because these breakouts tend to be very volatile moves, and what you often see is an explosive initial move, and while there are many instances where price continues to trade in the direction of the breakout without pulling back, in many cases what you will see is a situation where price breaks out of the range before pulling back and retesting the range, so retesting the level that it broke out and then continuing. Okay, now this can be frustrating for many traders. However, there is a way of capitalizing on this dynamic. Okay, so you can see in this example then that we have a really well-defined resistance level. Okay, so in this zone here, the 116.20s to 116.50s zone, so roughly 30 pip zone, you can see that we have a few key touches. Okay, and this has provided strong resistance. So we identify a really strong resistance level like this, and then we're anticipating that price is going to break out above it. However, what you can see highlighted in this example is the dynamic which we were just talking about, and this is something that tends to occur quite a lot, where price breaks out above the high of the resistance line, it trades back down, retests the broken resistance, finds support this time. Okay, so resistance has now turned to support, and then we continue to trade in the direction of the breakout. So for those of you who were in the support and resistance webinars that we've done, what's basically going on at this level is that we're seeing a shift in the underlying order flow. Okay, so the buying power, which was strong enough to take price through that resistance level, remains strong enough at the level to then act as support. Okay, so what we've seen along this level in the past is an oversupply. Okay, so we've seen more sellers at this level than we've seen buyers. So each time prices come up here, the buying power which has taken price up to test that resistance level has been overwhelmed by selling power. However, at this level here, we can see that buyers actually overtook sellers. So there were more buyers in the market than sellers. The price went up. Okay, so we know that the demand is strong in the market at this point. And then when price comes back down to retest that broken level, buyers step back in again and take price up. Okay, so broken resistance turns to support. So that's all we're seeing at this level. And as I said, this is a really common occurrence with these breakout trades, and it's one that traders can take full advantage of. So waiting to play the retest of the breakout is basically a way of waiting for further confirmation that the breakout is actually going to work. Because essentially what we're seeing here is the breakout zone acting as a pivot. So if price breaks out above the resistance level, and if we're going to see a full and sustained move, then a retest of the breakout zone should see price hold and support. Okay, so once price breaks out above this retest level, and then we trade back down, once price breaks out above the resistance rather, and then we see price trading back down to retest that broken resistance, we know that if this move is going to continue, if it's not going to be a false breakout, then we want to see buyers stepping in at this level again, and we want to see this level acting as support. So if price trades back down, retests this level and holds, then as price starts to move back up again, we can go ahead and enter the market, taking advantage of this dynamic. Okay, so if price breaks out above the range and then trades back down inside it, that's likely a failed breakout. Okay, so what we've seen there is a failed breakout, and there's no retest trade to make. But where we see price trade back down to retest this broken level, and then we see price stalling and holding, and we'll talk about reversal candlesticks later, but you can see here, for any of you who are familiar with candlestick reading, that we've actually got a bullish pin bar, which we're going to talk about shortly. Then this is a really good signal that this breakout is likely to continue and that the move has got some legs. So again, for those of you who aren't particularly keen on trading breakouts, because again, it's kind of a different psychological approach to trading a breakout and trading a reversal. So this would be more of a reversal trade. If you traded the initial move, that's the breakout. But then where you get this retest, what you're actually banking on here is a reversal from this point. So the market is moving lower into that retest, and then you're expecting that this level is going to hold and provide support for a continued move higher. So essentially what we've highlighted here so far are two ways of trading breakouts. So you can trade the initial move, looking to capitalize on that momentum as the market moves back into a period of expansion following a consolidation, or you can wait for price to break out, retest the broken resistance level, which you're expecting will provide support, and then trade a reversal higher. And again, if this was the other way around, if we were trading a bearish setup, we'd wait for price to break down below a support level and then retest the broken support level, which we'd then be looking for to provide resistance. Okay, so we just looked then at traditional breakout methods, the original breakout method, and then also the retest of the broken range. So let's now take a look at another area of price action trading, which is using price patterns. And the pattern that we're going to look at is actually one of my favorites to use. It's double top pattern, and this is one of the most popular price patterns out there, so perhaps you've heard of it. Okay, so this lovely illustration, which I've carefully prepared for you, is the basic structure of the pattern. Okay, and you can see why they call it the double top, because we simply have two swing highs which complete at the same level. And the shape of the pattern, you can see oftentimes double tops are also referred to as M tops because price tends to make this M shape. So buyers are in control, taking price up to this first level, where sellers then step in and drive price down. We get a short correction lower, giving us this reaction low, where buyers then step in to drive price back up. So we trade all the way back up to retest the level of that initial high, where once again sellers step in to overwhelm buyers in the market and drive price lower. Okay, so this gives us our double top or our M top, depending on how you want to refer to it. And this is a really classic and really common price dynamic that you'll see over and over on different time frames, as far back as you want to look through the charts and on any different instrument. So this occurs time and time again, and it's a really great pattern that it's possible to take really good advantage of. Okay, so you can see here then we've got an example of the pattern on the charts. Okay, so we get this initial move up, we hit our first high, sellers step in to drive price lower. We get down to this point here, so this is our reaction low, just as we looked at on the diagram. Buyers step in at this point, drive price back up. We trade all the way back up to test that first high. However, we're unable to get back above it. And once again, sellers step in to drive price lower and we break down. So you can see we've got that M shape again there. So this is our classic double top. Now, in terms of how we trade this pattern, there are two options really. So the first is the more conservative option, where we look to trade a break of the reaction low. Okay, so this is our reaction low. This is the key pivot for this pattern. We get our move up, we get our move down, we get a move back up. So at this point here, once market starts selling off, we can see that we've probably got our double top in play. And then as price breaks down through that reaction low, the structure of the trend has changed. Okay, because if you think about what's happening along here, so we're moving up, putting in higher highs and higher lows, higher highs, higher lows. But then at this point here, we fail to put in a higher high and we actually break down through that last low. So at this point here, we've broken the series of rising lows. So once that low is broken, we can go ahead and enter our short trade. So this would be a breakout trade, like we just looked at, trading the break of this low here. So we'd wait for a candle to close below that low. We'd enter short, and then typically what we'd see is our stop placed above the high of the structure. Okay, so we'll be short from around this level here. Our stop goes above the high of the structure, and then again we're always looking to target a minimum of 2 times our risk to maintain that positive risk reward profile over time. So it's simply a case of measuring the distance between your entry and your stop, marking it out on your chart, so you're looking to bank 2 times the risk on the trade. Now, alternatively, you can take a more aggressive approach, which is where you actually look to trade short from the high of the second top. So instead of waiting for price to break down below that reaction low, what we're sort of doing is front running the pattern. Okay, so we're expecting, once we've highlighted this high, okay, so imagine we're around this point in time here, price trades up, puts in a reaction low. As price is trading up to this level, we're anticipating that we could have a double top. So once price hits that level and stalls, then what we're looking for are some reversal candlesticks to form to give us the go ahead to enter a short trade. Okay, so we're identifying the potential second top and we're waiting for the market to give us a reversal signal to get short. So just before we take a look at an example of this in action, let's quickly take a look at one of these reversal candlesticks, which I like to use in this scenario. And I mentioned this earlier. So this is the pin bar candlestick. And reading candlesticks is really at the heart of price action trading. So it's great to have a couple of candlesticks which you can rely on. And the pin bar is one of my favorites that I use in scenarios like this. So let's take a look then. For those of you who aren't familiar, the pin bar candlestick looks like this. Okay, and the pin bar essentially gets its name from the old European story about the wooden boy Pinocchio whose nose grew longer every time he told a lie. Okay, so the idea with this candle is that the long wick represents the nose. So these pin bar candles have a long wick and then a small body, and this would be a bearish pin bar, and then if this was a bullish pin bar, it would simply be the other way around. So essentially what this candle demonstrates is a sharp reversal in sentiment, and this is why it's a really great predictor of a larger reversal. So if we think about what's happening, we opened at this point here. Buyers were in control, taking price strongly higher over the session until sellers stepped in and completely overwhelmed buyers and drove them all the way back down. And that's why we get this long wick and then this small body. And this is supposed to be an indication of a forthcoming reversal or a larger reversal. So the pin bar suggests then that price has been reversed over the session, and then we're likely to see a bigger reversal over the next candlesticks. So as I say, this can be a fantastic reversal signal, especially where it occurs in certain locations. So for a bearish pin bar then, suggesting a reversal lower, we ideally want to see the candle form at a resistance level. So in the example that we were just looking at where we had a double top, this is a perfect sort of resistance location where we'd like to see the presence of a bearish pin bar to give us the go ahead to get short. So let's take a look at an example then of that. Okay, so you can see here then that we've got a really well-defined textbook double top, just like we were looking at before. You can see again we've got that M shape. And then you'll notice that at the side of the second top, we've actually got one of these pin bar candlesticks. Okay, so you can see just as we looked at with the diagram, we've got this candlestick which has a long tail and then a small body. It's occurred at this resistance level. And so we've essentially got a candlestick here, which is an indication of a sharp reversal in sentiment over the course of that session. And we've got it at the completion of a classic bearish reversal pattern. So it's the confluence between this bearish reversal candlestick and the bearish reversal pattern which give us the go ahead to enter our short trade, because as I say, this is a slightly more aggressive approach because we're not waiting for price to break that reaction low. We're actually anticipating that we're going to see a double top form, and it's the presence of this bearish reversal candlestick which we use as the trigger for our entry. So as I said, it is a slightly more aggressive approach, but the beauty is here that so long as we're right, we get a much better entry on the trade and we can greatly reduce our risk, because this time the way that we'd enter the trade would be to wait for a break of that pin bar low, and then we'd simply put our stop above the high of that candle. And so again, we're always looking to target a minimum of 2 times our risk. So where we've entered a trade here and our stop is here, we've obviously got a very reduced level of risk, and so the market only needs to make a much smaller move to give us our 2 times risk reward. But the other thing is that from that point, we actually stand a much better chance of making a bigger multiple of our risk if we keep our trade open. Okay, so let's say we keep the trade open, targeting a move down to that reaction low. So if you remember, in the conservative way of taking this trade, we'd only be getting short as price breaks down through that reaction low. Whereas in this instance, taking a more aggressive approach and entering a little earlier, we're actually targeting a move down to that reaction low, and this gives us a much bigger return on our risk. So as I said, it's a slightly more aggressive approach, but it's a sound method because we're identifying confluence between bearish reversal candlesticks and bearish reversal price patterns. So this is a really beautiful example of a price action trading strategy utilizing these 2 combined approaches of identifying price patterns and then also identifying reversal candlesticks. Okay, so the final strategy that we're going to look at then involves using trend lines. And again, trend lines are one of the most common elements of technical trading. So you're perhaps familiar with them. They're essentially a dynamic form of support and resistance. So unlike the static support and resistance, which is just a horizontal line such as we see here drawn from this high to this high, trend lines connect highs or lows along a rising or falling gradient to give us dynamic support and resistance. So let's take a look at an example then. Okay, so you can see here that we have a classic rising trend line connecting these higher lows. Okay, so you can see what I mean now about connecting these rising or falling lows. So this is a bullish trend line. And typically, when traders identify a trend line like this in play, they will monitor price as it tests the trend line as the bullish trend continues, and they'll be looking to use the trend line as support to buy, expecting the trend to continue and develop. Alternatively, if they identify a bearish trend line where you'd be connecting falling highs, so lower highs, then they look to use the trend line as resistance to sell. Now, another way of trading using trend lines, instead of looking to use them as support and resistance, is to trade a trend line break. And this can be a fantastic way of capturing a change in market direction. But the problem is, trading trend line breaks can be notoriously challenging, as the market will often pierce a trend line, suggesting that a break is happening, before reversing and trading back inside the trend line. Okay, and many traders often get sucked into trading trend line breaks only to get trapped in a false breakout. So to guard against this, many traders will look to trade the retest of a broken trend line. Okay, so just as we were talking about earlier in the session with trading range breakouts, you can trade the initial break or you can trade a retest. And the same is true with trend lines. You can trade the break of a trend line or you can trade the retest. However, again, trading retests of broken trend lines can be just as difficult because the volatility around trend lines tends to make them very difficult to catch the correct entry point. And so a better way that I find to trade trend line breaks is to wait for price to break a trend line and make a new price point outside of the trend line, allow price to then come back and retest the trend line, and then wait for it to reverse and continue the original break. Okay, so let me just talk through that a bit more clearly then. So you can see in this example here, we have our rising trend line connecting these rising lows, these higher lows. Now at this point here, you can see that we've broken down below the rising trend line. Okay, so we've got our trend line break. However, buyers step back in at this point here and we get a reversal higher. Price trades back up to retest that broken trend line. In fact, we actually trade back above the trend line before then reversing and trading back down again. And you can see that sellers actually take control in a much firmer grip here and push price back down below that initial low, and then we get our proper sell-off. Okay, so this is a perfect example of what I was just talking about, where we wait for a break of the trend line, wait for a retest, and then we wait for that continuation. So it's kind of like a zigzag pattern. So in this scenario then, our entry would be on a break of this level here. Okay, so again, we'd be trading this as a breakout method. So we wait for price to break that rising trend line and put in a low. So this signals to us that a breakout is on the cards. We then wait to see if price reverses and retest the trend line, which it does, and then this will let us know whether the trend line, whether the break is a false breakout or whether we're likely to get some traction. So we retest that broken trend line, we chop around a bit, and then we reverse and sell off. So at the point the market breaks this low, we know that we're likely to see, or that there's a far higher likelihood of a breakout continuing at this level than when it first happens. Okay, so when that breakout first happens initially and we get the reversal, there is a strong chance that we're likely to just see a false breakout. But at the point that the market retests that broken trend line and then rolls over again, this is a really strong indication that we're likely to see a proper breakdown. So we can then go ahead and enter short on the break of this level here. And the great thing about trading in this manner is that we have a really clear location to place our stop, because we have this swing high from the retest of the broken trend line, which gives us this natural barrier to put our stop behind. And then again, we're simply looking to target a minimum of 2 times our risk. But you can see that we actually get a much deeper sell-off here, and you'll tend to find, and of course you can base this on your own chart study, that where you get this type of setup, this sort of slingshot move where price breaks out of a trend line, stalls, reverses, retests it, and then moves again, that we tend to usually get quite a big move. So this is a really great way of taking a notoriously difficult trade, because a lot of traders get sucked into trading the breakout initially or trading the retest. And because of the volatility here, it's just quite difficult to get those trades right. Whereas if you take a little bit of extra time and wait for a little bit more confirmation, then you tend to get these better moves. Okay, so we've had quite a dense session there and covered quite a few different strategies, and I hope that you found that interesting and useful to get a look at these different ways of approaching the market using price action trading strategies. So before we wrap this up, are there any questions that I can answer for anyone? Brilliant. Okay, well, I'm pleased you've all found that useful then and followed along well. And I hope that you're looking forward to getting on the charts and testing out these different strategies. As I say, we've kind of dipped our toes in a few different pools there to give you an idea of the different types of strategies and approaches that you can use. And as I say, there are many different types of price action strategies that you can look for. So hopefully this has given you a good example of the different ways that you can approach the market. Well, I look forward to catching up with you all again next time. And in the meantime, take care. Thanks a lot, everyone.